Good morning, everyone. Thank you for joining us for today's update on Income Provider with Henk Kotze. Henk will be discussing, amongst other things, the recent steepness in the yield curve and how this has affected Income Provider and if we are taking advantage of this. We'll also discuss the uptick in inflation numbers around the world and why we are not too concerned about this. If I can just quickly recap what we try and achieve with the Income Provider. The multi-asset income category has quite a diverse range of income funds within it. I don't believe that they're all comparable to one another. On the one extreme, you have income funds that act more like flexible bond funds, trying to time the duration cycle. And at the other extreme, you have high yield credit funds providing good yield, but they definitely come with a lot more credit risk. Income providers sit somewhere in between this. We use a diverse set of income producing assets to enable us to produce inflation plus returns every single year, aiming for CPI +3 over the longer term. But very importantly, we have a very strict risk target in place, aiming not to lose capital over any rolling three months. So we don't want clients to wake up one morning with a big drawdown in the income fund that they perceive to be a safe or conservative fund to invest in. If there's any technical issues, just bear with us. As with any webinar, please remember to post any questions you might have in the Q&A function on the webinar, and I'll have Henk answer them at the end of the presentation. So with that, Henk, over to you.
Thank you, Darby. Thank you for very eloquently positioning where we are and what we think and how we think about income funds. I think for most of you, this wouldn't be no surprise, but certainly what I do think and what we're very excited about, and you can obviously see on the screen that we've gone through a bit of a rebrand. We're very excited about it, and I hope that all of you also agree that certainly the new image and the new brand look and feel is closely aligned with how we think about things, creating certainty and really putting our clients first. So without further ado, let's jump right into it. I'm not going to spend too much time with you today. I think we're all very tired of listening to updates and webinars, etc. And there's lots of things to take care of. So let's get into the nuts and bolts of things. As Darby said, I'm going to start with a short performance update, just position how we think about Income Provider again. As Darby said, I do think in the current environment, there's going to be a big dispersion within the industry, and we do think that we hold a good place within that. We really focus on CPI plus returns, but with a very strong risk management framework and mindset. And I think that in the current environment, and certainly going forward, with real yields being very difficult to obtain, our ability to risk manage is certainly something that should set us apart, and we will showcase that in today's presentation. I'll then take a look at one of the key themes that is driving markets for us globally. That's really the steepness of the yield curve, and specifically looking at the US. We think that's been driven by some inflation expectations. Certainly, financial conditions globally is very easy. The Fed expanding their balance sheet by $120 billion a month still. And obviously with that comes inflationary fears, and I'll just show you some ideas around that, why we don't think we should be too worried about that. I think the market's a little bit ahead of themselves, why the steepness of yield curve should really be playing into our hands in terms of a risk on environment and risk assets being beneficiaries of a steeper yield curve. Look closer to the SA market, look at interest rates locally, the current sort of expectation of interest rate hikes, why we think that's maybe a little bit premature as well. Go into the, again, an update on the structural shift we've seen to interest rate locally, and why we have to use the other building blocks in our toolkit to generate our inflation plus return. And then finally, just look at some of the risk ideas and risk strategies that we've implemented to still get the CPI plus return, but with this risk management of not trying to lose money over a rolling 3-month period. So just a quick update on performance. I think what's very key, and Darby very well eloquently, as I said, positioned this, we are real return focused and not peer return focused. And that's a very key differentiator for us, and it's something that needs to hit home with our clients. We really focus on generating inflation plus returns in the income space. I think that's what clients want. And then second to that, we definitely do believe that clients don't want to lose money in an income fund. So what we do from a risk management perspective, or at least a risk target, is try and not lose money over any rolling quarter or rolling rolling 3-month period. We've been very successful in doing that. We do think we have the skill set to do that. We spoke about it at length at previous webinars. One observation where we haven't been able to do that was COVID last year, and all the takeaways we could take from that enhance our process. But certainly in the current environment, as I said, looking forward, we do think that our skill set and the way we position our income proposition should stand our clients in good stead to generate a risk-adjusted real return that is appropriate for an income portfolio. So some performance numbers, you guys would know this quite well. It's very nice to have March last year roll out of our 1-year numbers, so you can see obviously a very strong performance over a 1-year period. Speaks to the rebound and how we've positioned the portfolio, taking advantage of some of those dislocations. But what's very key for us is over all periods and since inception, certainly if you take inflation plus 3, we've hit that target, and that's, as I said, for us very, very important. Then on the risk management side, the rolling 3-month number, you can see very high hit ratio of not losing money over or not losing capital over a rolling 3-month period. Our risk target, and as I said, a very key differentiator going forward for us, with the one observation obviously being COVID last year. Still a very quick rebound from that, and still very much front and center and very anchored to the way we think about the income provider portfolio. And then the second part, just to show you calendar year real returns and that focus of generating inflation plus every year. And you can see even last year after fees getting just above 2%, not quite the 3% target, but if you take it over the long run, smooth profile since inception. If you compare it to inflation plus 3, you can see we kind of hug that line, and over time that we've done inflation plus 4.3 after the A2 fee class. So certainly a successful story for us, and we do believe that our recipe in how we think about income and how we manage this portfolio is one that has done well for us, and is a recipe that's a winner. Okay, so let's look at a theme that we think is driving markets, and we certainly saw some volatility in the first quarter around this. And certainly, yes, with all the liquidity in the system and all the money that the Fed's printing, as I said, $120 billion a month still, there's some inflationary fears, and certainly that's warranted. But we do think the market is getting a bit ahead of themselves. So let's look at this in some charts. So what we've done here is to take the 30-year inflation swap, so basically what the market in the US expects for inflation over the next 30 years. And we can see a sharp uptick from low levels of COVID. But if you look at the absolute level, and yes, we've got to bake in some risk premium here, not a lot more inflation expected than 2%. If you think the Fed target is average inflation of 2%, certainly this doesn't scream all that worrying to us. So yes, some inflation expectations coming back. We think it's healthy, certainly not running away with it. And we do think that the market is a little bit ahead of themselves, and it shouldn't really be a risk-off indicator for us. So what happened because of this inflation expectations, we saw the steepness in the US yield curve. So what do we mean by that? Comparing the 2-year to the 10-year bond yields, and the difference between the two, and you can see what's happened here is that the 10-year has moved away from the 2-year, or in other words, the curve has become steeper. So just to take a look at some other observations. So emerging market crisis, curve steepness, start of a very strong bull market. .com crash, steep yield curve, start of a bull market. Similar story, GFC, and we do think that a steeper yield curve should actually be a risk-on indicator, and not, as we've seen the first quarter of this year, as a negative indicator, which has been an interesting observation for us. What would be worrying is we see financial conditions tightening, and what we see, what could lead to that is the front end of the yield curve, or the Fed moving interest rates higher. And what we certainly, if you look at market pricing, that's not the case. And if you listen to the Fed, to Jerome Powell, that's also not something that they're thinking about. They keep reiterating that they don't think they'll be raising rates anytime soon, specifically not before 2023. So what we've done here is to take the 3-month LIBOR spot rate, so really the 3-month rate that a lot of the market assets resets against, and then taking that rate 2 years out. So what does the market expect for that rate to be in 2 years' time, and looking at the difference. So you can see, yes, they expect it to be a little bit higher, but that's not much more than one interest rate hike in the US priced for the next 2 years. So certainly not pricing in interest rate hikes in the US, certainly not tighter financial conditions, and certainly shouldn't be an indicator for risk off in the SA context. Looking at it a little bit differently, So this is what the market expects for the US interest rates. So with where current rates are, where they were about 6 months ago, and you can see, yes, on this chart it looks quite steep, but if you look at the actual numbers in 2023, really only one interest rate hike priced in the year. So certainly for us, nothing tells us that financial conditions should tighten. Nothing indicates to us that steeper yield curve should be bad for risky assets. And what we've done is to reiterate that, is to do some numbers around that. So what we've done in very basic terms, and thank you to the multi-asset team for doing the work around this. But what we've done is take different asset classes, look at how they react if the yield curve is steep. And I want us to focus around this block here, which is really the building blocks that we can use in the income space locally, and the combination of those in SA income. And you can see certainly from this picture that a steeper yield curve globally should inform a better risk on and a better environment for SA income. So certainly, again, to reiterate our stance that we might be a bit contrarian to markets, certainly a lot of fears from some of our clients around the steeper curve and some inflation expectations, but we think it can't counter to that is that actually this should be a risk on and a bullish sentiment or bullish indicator for us for the income space. Okay, let's draw a little bit closer to home. Look at the SA market, the SA interest rates, and certainly what's interesting here is there's some interest rate hikes being priced in. So yes, it's been pared back. So this is the chart, or the 3 month JIBOR rate over time, and what the market expects that rate, what that rate will do. And you can see certainly some hikes priced in. I would argue, and we would argue, and certainly I've told you this before, that we think that the steepness of the curve is really what's pulling up the back end of the FRA curve, or what's causing some pricing of hikes. And I think the second to that is what we call the Saab Qpm model. This is what I'm showing you here. Our view is that this is not a very good predictor of what interest rates will do. The model is very fluid, and we don't really put a lot of emphasis in this. But certainly, if you look at this, it's a bit busy. But March 21 was the last MPC meeting, the last time they showed us the model. And certainly what the model shows them is that in 2023, if you look at the top right, they expect the repo rate, what the model tells them that the repo rate should be 6%. So certainly, yes, that could spook some markets, and yes, certainly that will then lead to some pricing of interest rate hikes, but we would say that that is premature, and we would base it on this. So if you look at what the MPC expects, or the SA Reserve Bank expects for inflation, again, similar type of chart. So March 21 was the last meeting, and if you look at the outer year inflation, average inflation forecast of 4.5, that's smack bang in the middle of their target range of 3 to 6. So we would argue that really not a lot of inflation risk in South Africa. Shouldn't really lead to them being pushed into interest rate hikes. If the Fed's not going to move, we don't think that we should be moving. And certainly if you look at the growth picture, yes, we saw a rebound due to a very low base of COVID, but certainly structurally we do think that SA from a growth perspective is still being held back, and interest rate hikes in the short term shouldn't be warranted. And then just some interesting thoughts around this. So what we've done here is to look at the composition of how the MPC members would have voted, and you can see from cut, hold, hike. Hike hasn't been in their minds for some time. Certainly, yes, they've all gone into the hold mode, unanimously holding rates steady, but we don't see this changing anytime soon. And as I said, we don't think interest rates move higher in the near future. Okay, so let me go and draw back into one of the themes that we looked at in the previous webinar on what we've called the structural shift in the front end of the interest rate market, and why this is important for us in the income space where we try and generate inflation plus returns. So you would remember that what we looked at last year as banks and consumer balance sheets were hoarding cash, it found its way to the banks, and what we're looking at here is the cumulative deposit growth of the top 4 banks for the last 11 years, and certainly what we can see last year is a lot of cash being placed with the banks. So banks are sitting long cash. Yes, the scale doesn't look all that much, but I can assure you that that is a lot of money that's sitting with the banks. And on the flip side to this, credit extension is still very muted. So a lot of cash coming in, not a lot of cash going out. And that really means that the banks don't want to pay us for putting money with them. So what we're looking at here is how much spread are we earning for putting our money with the banks, and then comparing it to the 3-month reset rate, or the JIBOR rate that we reset the spreads against. So certainly if you look at Jan 2019 versus Jan 2020, about 8 and 7.5% you could have earned from 1-year money market, where sort of this year around 4%. So certainly on an absolute level, interest rates being very low, not a lot of compensation for taking bank risk or putting your money with the bank. And this for us is really a structural shift from previous years. And this is what this chart tries to show us. If you take the start of every calendar year that I'll show you at the bottom, and you placed our money with the bank for 1 year, compared it to the expected inflation for that year, and this turquoise bar was what we could have expected from a real return from money market. And you can see this year, obviously that is not going to be the case. It's going to be very difficult to generate inflation plus returns from using cash linked investments. And for us, that certainly creates an interesting environment to operate within. Obviously, our focus being on real returns, we have to use the different tools at our disposal to generate that inflation plus. So one of those would be, and it's interesting, I wanted to look at our yield curve as well. So comparing that to 2016, to give you an indication that yes, the curve hasn't always been this steep, and it's certainly now the steepest it's been in a very long time. And that's a very important tool for us that we can use still generate inflation plus. So for us to take some duration risk up the bond curve, where it's very steep, you get protection from what we call the roll down, lock in those real yields, and certainly still an opportunity for us in doing that. So how are we positioned in this structural shift? Using the different tools we have, and as I said earlier, the focus of inflation plus, using these tools we have with this risk management undertone, we think going forward in the current environment with the suppressed absolute levels of yield, people looking for different sources of real return certainly will increase the risk in this sector. The dispersion would be wider necessarily because of this, and we do think that we have the toolkit and the expertise to manage this risk really well, and to still give clients that CPI plus 3 return with a very smooth ride, and with not losing money over a running quarter. So what are some of these assets? And again, it's a bit of repetition from last time, but really I think the focus is on consistency and finding those sources of real return. And the first one really is on the offshore space, where we find some good yield in dollars for buying South African risk, so the SA banks and South African government bonds in the dollar market, and then we hedge back out the currency. So we'll buy a dollar asset, sell the dollar forward, bring it back into rands, take advantage of what we call the forward premium, which is currently about 4% for 1 year, and really create a rand asset that's yielding better than the equivalent asset in the local market. Apologies. Then the second one, as I showed you, the steep yield curve, we do think that you're getting paid for taking on some interest rate risk or some duration, and what's really key for us is try to lock in those great real yields for as long as possible. I'll show you where on the curve we are positioned and why we think that's the right area, and how we are managing the risk around this. We're certainly taking on duration risk in this sector, and certainly in this portfolio will introduce some volatility. And it's very important for us to manage that really well, and I'll show you how we do that. Preference shares, asset class we like. Here we look at the top 4 bank prefs. We understand the pref market well. Our view is that the market doesn't necessarily understand where the prefs would sit on the capital stack. When the Prudential Authority last year guided banks to cut their ordinary share dividends, our view was the market really lumped prefs into the same bucket, which is not really true. The Saab has no authority over prefs. Prefs sit higher in the capital stack, and actually they sit outside of the capital stack, not being under the ambit of Basel. So we like prefs. Bank prefs have done well for us for the last sort of Q4 and Q1 this year, and certainly relative to cash, it's a great asset for us in the spread that we earn better than cash there, and an asset that we can allocate to away from cash-linked assets to generate this inflation plus return that we are trying to generate. Then inflation-linked bonds. If we combine an asset that's linked to inflation with our inflation return mindset, obviously that's a great asset class. One of the assets we group in here is our renewable energy fund. That's an inflation-linked asset for us, a great asset and a great fund that our clients get access to via this portfolio. CPI plus 6 at the moment, all operational assets, obviously where ESG is very important in the current environment. The E component of that is very, very powerful. And where we focus on the government inflation-linked bonds, more on the front end of the curve, currently about real of 1.5. And if you think about inflation of around 4, that gives you a 5.5 yield, and that's certainly going to beat cash. So we don't need a lot of inflation in the SA context for inflation-linked bonds, certainly in the front end, to outperform cash-type investments. And then finally, property, great asset class. We think it's a very good asset class for income funds in the long run. Certainly from an inflation beating perspective, property should be one of the better asset classes. For us, still a lot of uncertainty in this space. We like it, the asset class for the dividend yield we can earn, and there's very little certainty around these counterparties being able to pay out dividends. Certainly some of them asking to reduce that payout ratio, some uncertainty around valuations and how that would impact their loan to value covenants in the debt space. So for us, good asset class, still too much uncertainty. Will certainly increase the risk here when we see the opportunity warrants it. A little bit more than 1% currently exposure, certainly defensive in that perspective, but going forward, certainly one that we would look to increase when we see the dust settle. There's some charts around what I've just shared. So very simply what we've done here, take the dollar bonds that the SA government has issued and hedge it back into rands, that's this blue line, and then compare it to the local bond curve. And you can see in the front end still where we like to operate from a risk return perspective on the income side, a great pickup for us by buying the offshore bond and bring it back into rands. Then on the duration profile of the portfolio, so historically what we've done, and you would know this, is we use the 3-year swap rate. This is the line you see on this chart to increase and decrease our interest rate risk or our duration. So where we saw spikes in the 3-year, you can see the blue bars or the duration of the portfolio increase, speaking to us seeing value and increasing the risk. But counterintuitively, more recently, the swap rate collapsing, or as I said earlier, the structural shift we've seen in bank rates, but the portfolio taking on some interest rate risk. So that is because of this chart. And again, as I said, the steepness of the yield curve. So what we've done here, again, is to show you the different maturity buckets for the South African government bond curve, and then the expected 1-year return of holding those bonds. So yes, there's a yield component and what we call a roll down component into this, and this should give you your total return for the bond over the 1 year. And you can see if nothing happens in the darker blue line, the great returns you could expect from owning government bonds. We think appropriately in terms of where else we see the risk. We like to be in the front end, or front end relative to Orbi, so 7 to 10 year area, and a very good real return that we can generate there. Obviously, with this risk management focus, going out back in for an income portfolio for us necessarily isn't the right thing to do. Then I've spoken a lot and I've made a lot of mention around risk management, and certainly looking forward, we do think that risk in the sector in terms of volatility of return will increase, and for us it's very important to use the tools we have to manage that risk and manage around that risk to create the smooth asymmetric return profile that our clients are used to. So we've identified 2 asset class or 2 assets in the portfolio that we do think introduces some risk. We've excluded property where we think they're still trading at very deep discounts and the exposure is fairly limited. The press we think has got some upside, and also don't think that introduces too much risk. But certainly for us on the offshore space, if something had to go wrong in the global market and our view on this risk dial moving towards positive and at least benefiting SA risky assets, the offshore component or the bonds we hold there would widen and should hurt the portfolio. So what we've done there, and this is an update from the previous webinar, is we've introduced some currency options there. So what we've done is bought protection against rand weakness. The thinking there is if something had to go wrong in global markets, the risk off environment plays out, the rand is a high beta currency, or it would reflect that risk quite accurately. This protection against weakness will then offset the exposure the portfolio has in the offshore space. So really focus on looking where the risk is, what's the best way, the most cost-effective way of hedging that risk, and really creating that peace of mind, knowing that if something had to be wrong and we're wrong in our assessment of markets, the portfolio is well protected. Then the second asset we do think introduces risk, and as I showed you, certainly we've increased our duration in the portfolio to about 1 year. This does introduce risk, and if we're wrong, bond yields sell off, the portfolio will be exposed. And what we've done here is bought put protection, or really the opportunity to sell bonds against our position at levels. This was very cost effective again, expiring in May. You think back to sort of February where we saw bond yields move wider, and you look at the return of the portfolio, that protection was very visible in the portfolio. So certainly contributing to a smoother return profile, not costing us too much. We are participating in the good yields, getting that real yield that we're wanting, but having these protection strategies in place that if we're wrong, we still create that asymmetry that our clients know us for. Okay, so then just in summary, focusing on delivering real returns in an environment where we do think it's going to be difficult to do so, and certainly going to introduce some more risk in the sector. For us, it's very key to manage that capital risk. Then, as I just showed you, a lot of focus around that. We remain conservative on our credit. Darby made a mention around some of the more heavy credit portfolios. We think we're not getting paid for the risk at the moment in the credit space. Not a lot of issuance, some coming back to market here and there, pockets of value, but for us, we remain conservative, focusing on high quality, mostly banks, some government bonds, and one or two small credit counters in the portfolio. The average term of the credit is important here, so only 1.5 years, so we've managed that down. Very limited spread risk in this portfolio as well. So compound positive real returns, make sure we manage the profile or create a smooth ride for our clients in an environment where we think certainly there will be some bumps in the road. Okay, so let's look at the portfolio positioning as of the end of March. Apologies, and you can see certainly a good mix of assets. This fixed bond component is the 186s that we've bought, introducing that a bit of duration to the portfolio, generates some great yields. The inflation component certainly just under sort of 10%, including the renewable energy portfolio. A little bit of offshore on the protection that we've bought, so just about 3%. That looks at the effective exposure. The hedge offshore exposure about 14%, good yield driver for us, but no currency risk there. And you can see a good mix of assets generating what we think is a very good yield in current environment, with not taking on all that much risk. Okay, and that's it from me. I really hope that the message is clear and concise, short enough, not taking too much of your time, and I certainly hope for some good interaction via the questions. So thanks again, Darby. If you can share some of the questions, that'd be great. Thank you.
Thank you, Henk, for a quick to the point update there. Quite a couple of questions here. I think let's start with crypto. No, I'm joking. Property. How long do you think it will roughly take before SA property market returns to break-even levels? The last 10 years have been quite terrific. Difficult to see it changing going forward, with shorter leases being taken up, co-working being adopted, and people working from home. Maybe just to add to that, why do you choose specific counters and not instead of, say, the SAPI?
Yeah, great question. It's obviously a difficult one to answer in terms of timing. We don't try and predict timing, but certainly if you think about one of the other themes that's kind of driving markets for us globally, if you look at the sort of on a house view level, is certainly the impact that COVID has structurally on markets. If you look at work from home, workplace activities and the like, there has been a shift in that, and how that plays out specifically around rent, leasing, this big office spaces, is more remote satellite type office spaces. Those are all things that we have to take into account here. Certainly our view is that in the SA context, it's still some time away before we see any sort of normalization. That then goes into why we like specific counters. We like to find those guys that are paying income, who've got a focus on that, who's paying us a good dividend yield, and that necessarily now trades at a quite deep discount to NAV. So we like those counters. We don't think the SAPI currently, if you look at the dividend yield of the SAPI, is really paying us for taking that risk. The uncertainty, as I said, is still there. And the comment I made around valuations for us is very key. So I wouldn't want to try and value a property in this current environment. And for that reason, I think there's a lot of uncertainty around the valuations of these companies, and in how this value then translates into how much debt they have. And that would then inform us in the loan to value or the gearing of a business. And we don't want to be in a position where valuation triggers a covenant on the loan to value ratio and then creates liquidity problems for a counter. So certainly we'd like to see a valuation cycle, see some numbers come through. But I think in answering the question from a high level, we do think that it will take some time still for SA property to, I think break even is a difficult one to assess, but certainly to a place where we think there's a bit more value and constructive value to be added.
Thanks, Henk. Then let's move on to credit. Quite a lot of credit questions, but I think you've covered most of that towards the end of the webinar. Maybe just break it down into corporate versus bank credit. You also mentioned spread risk. How would spread risk materialize in a portfolio? What does it actually mean? I think a lot of people understand duration, so just elaborate on that a little bit more.
Perfect. So there's two risks for us in investing in credit. One is we're taking a view on the counterparty, the counterparty we're lending the money to, or the bonds we're buying, and then secondly is at what price are we buying this bond. So the price speaks to spread risk, and the counterparty and default risk speaks to the counterparty. So on the banking side, for us, banks are high quality, and they're very well regulated. Basel regulates how much capital they need, where they have to issue in the capital stack, etc. And our view and our assessment of our banks is that we are very privileged as South Africans to have a very, very strong banking system. So for us, we would group bank as a high quality credit. We certainly do still think it is a credit counterparty, but the top 4 banks for us is a very healthy credit. And if we move away from banks, we start looking at some of the corporate names, MTN, Discovery, Momentum, some of the property counters. They would also issue debt. And here for us, because of the structural nature of the SA credit market, a lot of cash chasing and a few assets, we've seen the pricing or how much we're getting paid for taking that risk compressing, and certainly for us not showing us a lot of value. So the concept of spread risk or pricing risk in the credit is if I had to go buy a 5-year MTN bond at this point at 2% above JIBAR, and in a week's time that has moved to 4%, where necessarily there would be value. That 2% movement in the spread on top of the interest rate is where your spread risk comes from. So it's a 5-year instrument, 2% times the 5 years, what your exposure would be. That's a 10% knock that you will take on that bond position. So if your portfolio has an average term of 5 years, in credit that moves, so let's say your average term is 5 years, the spreads move by 1%, which is not inconceivable, your portfolio will be down 5%. So those are the 2 key risks. I think the spread risk one is that's the one that's not as well known. Certainly we all understand the default risk and not getting paid back the money, but on the pricing side, on the spread risk side, there's certainly also a lot of risk there. So it's always key to understand the transparency of pricing in portfolios. For us, quality instruments trade, so there's liquidity. When they trade, we see the mark to market. Less liquid credits, unfortunately, don't trade that often, obviously, and those spreads don't move. And for us, there is some risk in pricing in portfolios.
Thank you, Henk. At what USD ZAR levels would you start increasing your exposure, offshore exposure or FX exposure?
Yeah, so that's a good question. One, we don't try and predict where the currency goes, and 2, we try and have an assessment of fair value using a PPP model. But in this portfolio, if you think about our risk target of rolling 3-month positive returns, taking on dollar exposure or currency exposure nakedly in the portfolio introduces too much volatility for us. So we like to harvest that interest rate differential by selling the dollars, buying the rand forward, to get yield in the portfolio, and then take currency views in the portfolio via options or derivatives. So currently 10% of the portfolio is expressed in pounds and euros. So if the rand had to weaken, 10% of the portfolio is exposed to those via options, but 100% of the portfolio in physical assets is hedged into rands. So I won't like to call it level, but certainly we do think that there's a lot of value being added by using options rather than physical currency to give you that exposure and really to use it as a risk management tool if something had to go pear-shaped.
Thanks, Henk. And then one last question. Performance has been very good over the past year, but what should or could clients expect of the fund going forward, say, for the next 12 months?
Yeah, that's a good question. But so if you look at the current yield of the portfolio, around 6.3, 6.4%, that's only the yield. So if nothing changes, that's the yield. That excludes the roll down in the 186s. So that should add another 0.5% to 1%. So anything between 7 and 8%, I think, would be a very good outcome. But certainly, as I said, what's very key for us, and not to put a number to it, is to get to that CPI +3 target that we have. So That's what we try and achieve, always have these compounded positive real returns. And as I said earlier, and I think I've said this a number of times, I think a lot more key this year will be that risk management. Try and create a smoother ride, don't have those drawdowns, and then compound those positive real returns.
Thank you. I think with that end of the webinar for today, thank you everyone for joining us. Thank you, Henk, for your time. Have a good week, and until next time then. Bye.
Thank you. Cheers. Bye-bye.